that retention will become a line. Now, what are the function of the reinsurance? There are various functions like additional underwriting capacity will be given. Like say, suppose if reinsurance is not there, in that 500 crore risk would not have been accepted by the new insurance, because that is not Nunda cannot keep entire things on their balance sheet. But because that reinsurance arrangement was available, Nunda accepted the 500 crore and 300 crore was transferred. So that additional capacity is available here. Next one is a further spreading of risk internationally. Now, what is happening? So now in this example only, what I said that the some risk was transferred from JSC Re to Swiss Re. Sometimes even we can also transfer, but we have to see what are the IRDA guidelines, and after that only we can transfer the risk, because IRDA's main motto is the retention of maximum risk in a country. Okay. Next one is to expand the volume of business it writes at a faster rate. So suppose New India wants to now India already established a company. Suppose a new company is introducing, like new or something is introducing in an insurance market, and in that, what's happening? That they want to introduce a new, they want to go to the new market, or they want to introduce a new product. So that time, if they don't have any expertise, so with the help of reinsurance, even they are getting a capacity also, and also they are getting expertise advice also from the reinsurance company. So because of this, they can expand more faster. So these are the functions. Now, if you see traditionally, the basic role of reinsurance is to offer the protection against the above risk. So what are the risks? Random increase in the frequency and severity. See, now when you accept any risk, there are two things which are basically you have to look after. One is the frequency and another one is the severity. Now, what is the frequency? Frequency means repetition of the claim. How many times claims are appearing? If you see motor claims or health claims, in that, even particularly in the health claims, you will find that frequency is more, because there are so many claims are coming under your health policy. And severity is a quantum. If the claims are coming at a huge amount, so that will be of a huge severity. So these two things should be looked after, and reinsurance looking after. So for the frequency, if claims are smaller, if you see that if health claim is coming, now what will be the health claim? It will be of 2 lakh or 3 lakh or 5 lakhs. A company can easily take it on their books. But if you see at a larger picture, we will find that 2 lakhs or 5 lakhs will not only the 3,000 100 or 200 claims. There will be a lakhs of claims. So in total, this will become a greater amount, and then company cannot keep this on their book. So for that, they can arrange some reinsurance contract. There is one more thing, is the severity. Now sometimes risk is not so often. Means sometimes risk will come maybe once in a 5 years or once in a 10 years. Okay, but that risk will take entire profit of that 5 years or 10 years. So that severity is also affecting the insurance company. So in that case also reinsurance is required, and that support will help through the insurance company. Then random increase in the frequency and the severity of an accumulation of losses. So third thing is that, which is called accumulation. Accumulation means at a particular place there are so many risks involved. I will show you this picture. If you see this picture, you can see that there are so many risks are involved here. See, if any catastrophe happens over here, now all these risks may be insured through various different policies. But if these are with the same insurer, even with the same catastrophe, that insurance company may become bankrupt. So to avoid that, reinsurance will be arranged. Now, what is the capacity? Capacity is a net retention plus obligatory cession, plus if there is any pool, then the participation in the pool, intercompany cession, and then again some treaties are there. Now let's go one by one. First is the net retention. Net retention, as I already told you, that whatever is kept by the insurance company on their books, like in previous example, 200 crores were kept by New India Insurance on their books. So that is called a retention. Next one is a obligatory cession. Now what is obligatory cession? Now IRDA has mandated that particular percentage of each and every risk needs to be transferred to the national re, which is a GIC re. Currently, that percentage is a 4%. Remember that. Okay. It is started from 20% and became 15, 10, 5, and recently it is from 22, 23. It became 4% from 1st April 2022. Okay. Then next one is a pool. Sometimes what happens, there are such a risk which insurance company avoids to accept, like a terrorism or say motor third party, because if you see in motor OD proportion is profitable one, but third parties, there are so many claims, so no company wants to take a third party. So to avoid that, there can be arranged a pool so that all companies can come together, then they can contribute a premium there and can share the losses on the proportion as they contribute. So this is the pool. Next one is the intercompany session. Sometimes
How
maybe
much?
within
How
companies
much?
also there can be exchanges of the balance, exchanges of the risk. Maybe so New India is giving some fire risk to the Oriental. In return, some other engineering risk is transferred by the Oriental to the New India. That is called a intercompany sessions. And last one is treaties. Now treaties can be of different, maybe a surplus treaty, quota share treaty. There can be a non-proportional treaties also. So all this together becomes a capacity to a particular insurance company.
Sir, how
Now,
much
what is
is the
the retention? I already
obligatory
told you.
session?
It is the amount that the insurance company can put at stake for its own account when underwriting a single risk or a group of risk. Okay. Now, retention, I already told you. Basically, company keep low retention, maybe between 1 to 5%. Now, what are the types of insurance? First one is a facultative insurance. Second one is a treaty, and next one is a facultative obligatory treaty. Let us see one by one. First one is the facultative. Now, in simple term, you can say that facultative is a one-off type of contract. Like an insurance company, like an insured is coming to take a policy from us. Likewise, insurance company is going for a particular risk with a reinsurance company to take a single policy. So that is a one-off contract. That is a facultative insurance. It is not a pre-agreed contract, but after suppose say one particular risk is there like of 1,000 crore, and insurance company don't want to keep everything on their books, so for that particular risk only insurance company will find some reinsurer and will replace with that insurance company. So this will be a facultative insurance which is not predefined, but after the at the time of accepting the risk only. Please hold on. Am I audible again?
Yes, sir.
Okay, thank you. Okay, so we were discussing about the facultative insurance. So this is the oldest one contract, because when reinsurance started, this is the oldest method. That time only facultative insurance was available. Later on, that treaty was developed, and here each risk we are insuring separately. Now you will find that this is a time-consuming process. Why? Because for each and every risk you have to arrange the reinsurance. It is not predefined or pre-contracted or something like that. So for each and every risk you have to find this one, and similarly, it is a risky also. So sometimes you will not find a reinsurer. So you will not be able to accept the risk. So that's why this is a time consuming or the and the risk bearing also. Also, it is not binding on any of the party. Means even insurer is free whether to transfer the risk or not, and even reinsurer is also free whether to accept or reject. And if wants to accept it, he may accept partially also or fully also. So that is the case of the facultative reinsurance, because one of the one by one the contracts will be discussed, and it is not binding on any of the parties. Now, what are the disadvantages of it? First is a laborious. It takes so many works are involved, delay and time consuming. Premium rates are too high because insurers are aware that only bad risk will come, or only a huge risk will come. So they charge more premium on for that, and the commissions will be less for this contract. So these are the disadvantages to the insurance company. Now, uh, in which situations you will take the facultative insurance? First of all, when all other methods are exhausted. Generally, each and every company must be having a treaties. Okay, so all the treaties capacities exhaust, that time we can arrange this facultative insurance. Second, market expansion. Sometimes if you want market expansion for that to enter, that time you can take this one. Next is the reinsurance pay. If sometimes it is not required, or it is not a requisite that you want the capacity only, or instead of that, sometimes you want some expertise on a particular issue, you don't have that knowledge. So if you directly contact the reinsurance company, they can provide their expertise also. So for that also, sometimes facultative insurance are arranged, and this will be at par with the original insurance, because on the basis of the SIC, all the terms, conditions, and rates will be as similar as your original insurance policy only. So it is at par with the original insurance contract. Now, what is the treaty insurance? Now, see, in facultative, we have seen that we have arranged for each and every risk, we have to arrange it separately. But in treaty reinsurance, it is a predefined contract. Now, say, suppose we are arranging a treaty for, say, a fire portfolio. So whatever risk we are underwriting for the fire portfolio, each and every risk will go to the reinsurer. Now, this arrangement is binding on both the parties. Now, if I am accepting one, suppose I am having a fire treaty, in that I am accepting a particular risk of a fire insurance. In that, if I decide that I don't want to transfer a risk, I cannot do that, because each and every risk needs to be transferred, and after transferring, even reinsurer cannot reject it. So it is binding on both the parties. Don't have choice to any one of them. So if risk is falling under a particular treaty, then the risk must be transferred and also to be accepted by the insurance company. Now, these treaties are all generally on financial year based. Each risk need not be studied because everything is going under the treaty, and it is a simple and costing. So what were the disadvantages of the facultative? These are overcome by the treaty insurance. Now, we'll see the PML. What is the PML? PML is called as a probable maximum loss. Now, what is the probable maximum loss? Say I have insured a particular risk. Say Reliance Industries at Airoli or Koperkerne. It is a huge industry over there. Okay, so suppose 5,000 crores I have insured over there. Now, in any unwanted event, it is not necessary that all 5,000 crore will be burnt up. Okay, there may be some savings, there will be some salvages. So what would be the maximum possible loss? That is called a probable maximum loss. Maybe in particular, suppose there is a fire risk. In that fire risk, what happened? Due to that fire, some portion is burnt up. After that, due to some efforts, say 200 crores is saved. So out of 500 crores, if 200 crore could be saved, so that will cover the 300 CR is a PML for that particular risk. So it is a maximum probable loss for a particular risk is called a PML. Now, why that was important? Because the reinsurance are sometimes are placed on the basis of sum insured, and sometimes it is based on the PML basis. Now, next one is the facultative obligatory treaty. Now, we have seen facultative also and obligatory also. So here, facultative obligatory is a combination of these two things. Now, how this is a combination? Now, here it is a facultative to one party, and obligatory to the other. Now, for whom it is a facultative? So it is a facultative to the insurance company. Means particular risk, if coming to the insurance company may decide whether to keep this risk on their book or to transfer it to reinsurance company. So here they are getting a choice. So it is a facultative to the insurance company. But if risk is transferred, then there is no choice with the reinsurance company. They must accept that risk. So it is obligatory on the part of the reinsurance company. That's why it is called a facultative obligatory reinsurance. Now you will say that then why this arrangement will be done? Because it will happen that only bad risk will be transferred by the insurance company to the reinsurance company. They will keep good risk with them, and only bad risk will be transferred. But these arrangements are done basically in a soft market. Now, what is a soft market? When there is so many reinsurer providing coverages and demand is less, that time uh, reinsurance companies are ready to take anything. So in that soft market, these things are done. Uh, uh, all other things we have discussed, it is a combination of a facultative and treaty. Direct insurer has option, but reinsurer don't have, and it is done risk wise. Here you will see that rates will be higher because you know that in mostly bad risk are transferred, so rates are high, and there will be no commission under facultative obligatory treaty. Now, this is the arrangement in insurance facultative and treaty. Two forms are there. In each, you will find a proportional and excess. Excess means non-proportional only. It is the excess of loss, which is also called as non-proportional. In proportional, you will see that quota share and surplus. In excess of loss, you will see per risk or catastrophe. Now, let us see one by one. First one is the proportional treaties, in which you will see these two. First one is a quota share treaty. Now, in quota share treaty, you will see that insurer and reinsurer decides to share premium and also in pre-decided percentage. So here, uh, uh, it is defined like that. Each and every risk of the fire insurance, 20% risk will be transferred to the say XYZ reinsurance company. So for each and every risk, 20% will be transferred. So if I am writing a risk of say 5,000 5 crore rupees, premium is 5,000 rupees. So 20% risk, say out of 5 lakhs, 1 lakh will be transferred to the reinsurance company, and out of 5,000, 1,000 will be transferred to the reinsurance company. So premium and the losses will be shared in a equal proportion, pre-decided proportion, we can say. Applicable for each and every risk falling under the pre-decided terms. Now, one example is given here, like insurance returns 10% of each and every risk and transfer 90% risk. So again, the example is, suppose sum insured is 5 lakhs, then in that case, ceding insurer is keeping 10%, that is a 50,000, and reinsurer is keeping 90%, that is a 4,50,000. Now, can somebody tell me, if there is a loss of say 50,000, how much will insurance company will pay and how much insurance company will pay? Can anybody tell me?
10
If the
and
return
40.
is rupees,
10,
yes,
5,000 and
10 and
45,000.
5,000 and 45,000. Yes, very good. So in quota share, what is happening? We are sharing in the pre-decided proportion. Although ceding insurer company's retention was 50,000, but that entire 50,000 loss will not be paid by the insurance company. It will be when it is a quota share. So even the loss is coming under the retention, whatever retention was there, because we are keeping retention in terms of percentage, not the amount. So that accordingly in that basis, or and this is a proportional. So 10% will be kept by the insurance company. So 5,000 will with the insurance company, and 45,000 will go to the reinsurance company. Next one is insurer returns 20% and reinsurer transfer 80%. So again, similar example is there. You can, I think you can calculate this by your own also. Now, that was a fixed quota share. So in fixed quota share, what is happening? That the share is fixed. In the treaty itself, it will be mentioned that 80% risk will be transferred. So 80% quota share or 60% quota share. But there is one more quota share, which is called a variable quota share. Now, as per the name only, you can see that there will not be a fixed percentage. Percentage of the risk will be, means session will be different for the different risk. So what is happening when there is a lesser sum assured, insurance company can keep higher percentage for the retention, and maximum will be transferred. But when sum assureds are increasing, so their capacity is reducing, so that's why they are keeping a lower percentage, and maximum will be a ceded. So this is as as per the increase in the sum assured, you can see that there is a decrease in the retention percentage. So see here in first risk there was a 5 lakh. So 10% means 50,000 was kept and 450 was transferred. Next risk in say 50 lakhs, 7.5% was kept. So now see percentage is reduced. So 3 lakh 75,000 was kept. So accordingly it is changing. Now what are the advantages of the quota share? First one is a simple mechanism. See, now if percentages are pre-decided and fixed, so for after accepting any risk, you do not need to calculate anything. Simple, there is a simple calculation. Out of each and every risk, there will be some particular, say 20% quota share or 80% quota share. So 80% quota share, so 80% will be transferred to the reinsurer. Accordingly, there is a simple calculation, simple mechanism. Uh, when there is a new insurer, they can opt for it because they don't have any knowledge of the market. So what they do, they opt for the quota share, so that in each and every risk the reinsurer will be involved. That's why they opt for the quota share. Secondly, existing insurer can also use it, but when they want to enter, or even regularly they are using it, but if they want to enter into a new territory, or they want to launch a new product, and they don't know what will be the result of that, outcome of that particular product, or how the risk will be there in a new territory. So that in that case also existing insurer opt for the quota share. In quota share, you see that ORC will be higher. Commission will be higher in the quota share, because what is happening? Each and every risk is transferring to the insurer. So it is more profitable to the reinsurance company because there is no choice. Even good risks are also getting transferred to the reinsurance company. Now, our obligatory cession, which I told you that 4% is obligatory cession with the GIC, that is also a form of a quota share treaty only. Sometimes they may ask you the 4% obligatory cession is which kind of the reinsurance contract. So it is a quota share treaty. Now, whatever cession we are making to the, or whatever cession we are doing to the GIC, which is our national re, out of that, GIC again retrocede 50%. I already told you retrocession means reinsurance of reinsurance. So that 50% will be again reinsured with the Indian reinsurer. So the company who are ceding to them, 50% retrocession will be done by the GIC. Now retention, I already told you the amount which is kept on the book. So it is expressed in terms of amount, and insurance company retention is also called as a line, which I already explained to you. Now there are various factors which influence the retention, whether retention to keep lower or higher. Suppose insurers assets, capital and freezers are good, or having good financials of the company, so they can keep more. But if they don't have so good financials, so they will keep lower the portfolio of the risk. If risk is good, obviously more retention will be done. For bad risk, retention will be lower. Corporate liquidity, if liquidity is good, at the time of claims they need a hard cash, so liquidity is good, they can keep more. And for if liquidity is not good, then they have to retain a lesser one. Then state of reinsurance market, sometimes reinsurance market are very means regulations are very hard. So in such a situation, we have to follow the as per the regulatory forms or regulations only. Legal imposition, if there are very tight legal imposition, so according, yes, any doubt? Hello, hello, any doubt, or shall I continue?
Continue, sir.
Okay, thank you. Next one is the surplus treaty. Now, surplus treaty is also one of the kind of proportional treaties only. quota share which you have seen is also proportional and surplus is also proportional. Now what is the difference between quota share and surplus? If you have seen the quota share, in that you must have find that it was mentioned in terms of a percentage, but in a surplus treaty it is always mentioned in the terms of the amount. Okay, so what is the amount that is mentioned there? So what is the line or what is the retention is mentioned here, and ceding company's retention of liability will be whatever mentioned, that will be a mentioned as a maximum retention. So even insurance company can keep lower than the retention also, but if they are keeping lower, then cession will be also be lower, and then again balance will come back to the insurance company only. Now we can see with this example, in a stock of cotton, if suppose maximum retention mentioned, say the term mentioned is maximum, so remember this is the maximum retention, so insurance company can keep lower than that also. Okay, so 10 lakh is the retention. So if sum assured is 10 lakhs, so entire will be kept by the insurance company. So now along with that, I will ask you some question also. Now in first risk, 10 lakh was the sum assured, so retention is at 10 lakhs. Suppose there is a loss of say 5 lakhs. How much will be paid by the insurance company, and how much will be paid by the insurance company? If loss is of 5 lakhs rupees,
Insurance company will pay 5 lakhs and insurance 0.
very good, because entire risk is kept by the insurance company. Nothing was ceded. So everything will be paid by the insurance company. Next risk is of 50 lakhs. Now in 50 lakhs, what is happening? The maximum retention limit is 10 lakhs. So 10 lakhs is kept by the insurance company and 40 lakhs is ceded. Now tell me, suppose there is a loss of say 10 lakhs. Now how much will be paid by the insurance company and how much will be paid by the insurance company?
10 lakhs by the insured company, 0 by the reinsured.
The 2
No,
lakh
2 lakh by the insured company and another 8 lakh by the reinsured company.
Correct. The second answer is the correct one. Now see, although 10 lakhs is kept by the insurance company, but 40 lakhs was transferred to the insurance company. Now suppose the premium is say 5,000 rupees. Now in that 5,000 rupees, 4,000 is paid to the insurance company. So the risk is shared in the proportion of 1:4. 10 is kept with the insurance company, 40 is transferred. So risk is shared in the proportion of 1:4. Although 10 lakh is the retention, but entire 10 lakh will not be paid by the insurance company. That is the difference. So what will be done there? Risk means sum assured is shared in the proportion of 1:4. Premium is shared in the proportion of 1:4. So likewise, loss will also be shared in the proportion of 1:4. So if there is a loss of say 10 lakh rupees, 2 lakh will be paid by the insurance company and remaining 8 lakh will be paid by the insurance company. I think this is clear. Is this clear? Let's move to the next example. Is of 80 lakhs. Okay. In that, again 10 lakh is kept by the insurance company and 70 lakhs was the transfer. Now in this, if there is a loss of say 8 lakh rupees, now how much will be paid by the insurance company and how much will be paid by the insurance company?
1 lakh by the
1 lakh
insurance company, 7
and
lakh
7
by
lakh.
the reinsurer.
Very good. So you understood the concept very well. Any doubt on this? Because this is happening. You are like, when I asked in second example that how much will be loss payable, there was some another answer, and this will be there in your examination. That option will be there, and you will answer that will go wrong. So this should not happen. That's why
Sir,
I'm
can
taking
you
this
repeat that?
example.
Can you
Okay.
repeat those examples?
Okay. Now see the second example. In that you will find that the sum assured was 50 lakhs rupees, right? In that 50 lakh rupees, retention was 10 lakhs. So what happened? 10 lakh was kept by the insurance company and remaining 40 lakhs was transferred to the insurance company. Okay. So here it is a proportional treaty. So everything, risk, premium and losses are shared proportionately. So whatever loss will be there, even a single 1 rupee loss is also there, still it will be shared in a proportion. Now what is the proportion? Proportion is of retention is to whatever cession is there. Now what is the retention here? Retention is a 10 lakh and cession is 40 lakhs. If you take the proportion, what will be the proportion here? What will be the ratio? 10 lakhs to 40
1
lakhs,
is
what
to
is the
4.
ratio? 1 is to
1
4.
is to 4.
Oh,
So whatever loss is there, so say there is a loss of 1 rupee, then what will happen? 20 paise will be paid by the insurance company and 80 paise will be paid by the reinsurance company. Likewise, if there is a loss of say 5 lakh rupees, then 1 lakh will be paid by the insurance company and 4 lakh will be paid by the reinsurance company. Am I clear?
Yes, sir.
Okay, any doubt?
No, sir.
Okay, so moving forward, so this is the surplus treaty. I hope I have clarified each and everything over here. Now, it is not necessary that there can be only one surplus treaty. There can be a multiple surplus treaty. So after beyond first surplus treaty, there can be a second surplus treaty or third surplus treaty. So suppose in say there is a now this is the arrangement for but before going that again I'm coming back to the line which I already explained you. Now what is a line? Line is a retention. Now in this case, what is the line? Can anybody tell me what is the line here?
10 lakh.
10 lakhs.
10 lakhs.
10 lakh is the line because retention amount is a 10 lakh. So 10 lakh is a line. Say this particular example is a contract for say 7 lines, okay, or 8 lines say. So if 8 lines are there, then what will happen? 10 lakhs will be paid by the insurance company and up to 80 lakhs only will be transferred to the insurance company. Now what happens? Suppose there is a risk of say 1 crore. It is a in lakhs, so there is a risk of 1 crore. Now in 1 crore, what happens? 10 lakhs will be with the insurance company. But how many lines are there? 8 lines.
8
8
lakhs.
So
lines.
how much maximum cession can be done here?
80 lakhs.
80 lakhs.
80
Now 10
lakhs.
lakhs with the insurance company, 80 lakhs with the reinsurance company. So only capacity for this is 90 lakhs. Remaining 10 lakhs will again come back to the insurance company. Okay. So for that again insurance company has to pay. But to avoid that, sometimes even they can keep a
Second surplus treaty.
surplus treaty, say of 4 lines or 3 lines. So second surplus treaty, third surplus treaty. So whatever balance is there, so it will go to the next surplus treaty. Okay. Now sometimes retention will be on PML basis, sometimes it will be on a sum assured basis. Border ops will be the register of the risk will be shared
Sir.
by the insurance company with the insurance company.
Excuse me, sir.
Yes, any doubt? Yeah.
Yes, sir. In second surplus treaty also the same proportionately it will be divided, the claim.
Okay, I will take one example, then it will be more clear. One second. Okay, now I'm taking a last example. Fine. In last not the last one. Say one crore, which I already told. Okay. Say suppose there is a first surplus treaty is of 8 lines, second surplus treaty is of say 5 lines. Okay. Now what is happening? Risk is of 1 CR. Now how much will be with the insurance company?
10
How much will
lakhs.
be with the insurance company? 10 lakhs.
10
Is it?
lakhs.
Right. How much will be the first surplus treaty?
80 lakhs.
80 lines.
80
Because
lakhs.
there are 8 lines. So 10 multiple of that 10 lakhs, 10 lines into 10 lakhs into 8 lines. So it will be 80 lakhs. And what will be with the second surplus treaty, which is of 5 lines? How much will be the second surplus treaty?
50 lakhs.
Not
10
50
lakhs.
10
10
lakhs.
lakhs.
10 out of
10 lakhs.
50.
Yes. Only 10, because what is happening? Because although they have given a capacity of 5 lines, means 15 lakhs, but in this risk already 90 lakhs is already taken by insurer and first reinsurer. So only 10 lakhs is balance, only 10 lakhs will go there. So is this clear how risk is shared here in 2 surplus treaties? Is this clear? Shall I move towards the claim now?
Yes, sir.
Okay.
Yes, sir.
Now in this particular example, say there is a claim of 5 lakh rupees. So how much will be paid by whom? Go one by one.
Sir. Insurer.
Insurer will
Insurers
pay
will
5
pay
lakhs.
5,000.
5
5 lakhs. Insurer will be paid 5 lakhs.
Insurer will pay 5 lakhs. Again, you are making same mistake which you have made at that second example. Insurer will
Insurance
not
will
pay
pay
5 lakhs. It is a proportional, na? So it will be again shared.
50,000. He will pay 50,000.
Insurer will pay 50,000. Okay.
Yes.
And
Okay.
first surplus 4 lakhs,
First surplus
and
will
last
be
one is
how much?
50,000. 4 lakhs.
First surplus how much?
4 lakhs.
4 lakhs. Okay.
Yeah.
And second surplus?
Again 5,000.
Okay. Good. See, again I'm explaining this. See, insurance company has kept 10 lakhs. First surplus has kept 80 lakhs.
80
Second
lakhs.
surplus has kept 10 lakhs. Okay. So what is proportion now? 1:8:1. So even 1 rupee loss again will be shared in these three in that proportion. Okay. So 1:8:1. So if 5 lakh is there, then how much will be there? In 5 lakh, it will be a 50,000, 4 lakh, and 50,000. Am I clear? Hope your all doubts are cleared by this example. Is it?
Yes, sir.
Shall I move forward?
Yes, sir.
Yes, sir.
Okay. Now, see here, examples are given, but whatever examples are mentioned here, I already explained it in the previous slide only. That sum assured is say 80 lakh, retention 20 lakhs, 2 lines TT. So 40 lakhs will be transferred. All these are I already explained. Surplus TT of 10 lines of 200 crore. What is retention? What is surplus TT? Tell me quickly. What is the retention here? 10 lines of 200 crore. What is retention?
200.
20 crore.
20 crores.
20 crores.
No. 10 lines of 200
2000,
crore
sir.
is 200 is
2000
retention.
crore. 2000
So
crore.
retention is a
Retention is 200 crore.
only.
200 crore.
200 crore, not 2000. And session will be, or a surplus TT amount will be 2000 crore.
2000
And if
crore.
they will ask you the capacity, what will be the capacity here?
2200.
2200.
Correct. 2200 will be the capacity. So three terms are clear over here. Okay. Next. Sum assured is a 4 crore, retention is a 10 lakhs, surplus TT 8 lines, premium rate 2%, loss is 20 lakhs. Now tell me how much loss is recoverable from the reinsurer. Tell me.
$10 lakhs is recoverable from the reinsurer.
Okay, any other answer? Please tie yourself now only, so that if you are making any mistakes, it will be rectified here itself.
16 lakhs from the reinsurer.
Okay. So if such question is coming, you have to go step by step. Okay.
4 lakh from the reinsurer, 16 lakhs from the reinsured.
Okay. Let us see what is the answer. First, you have to calculate the reinsured amount. What is the reinsured amount? So it will be a lines multiplied by retention. Lines are 8, retention is a 10 lakh. So 80 lakh will be the reinsured amount. So what will be the reinsurance premium over here? If premium rate is 2%, sometimes if they will ask you the premium, so again, whatever session is there, 80 lakhs into 2%, then 1,60,000 will be the premium. Now, loss between reinsurer and reinsured. Reinsured is also insurance company. Remember that. Now, apportionment will be total loss is 3 crore 20 lakhs. Again, what we are doing, there is a simple formula that loss amount multiplied by reinsured amount divided by total sum insured. Now, what is the total sum insured? 4 crore. And what is the reinsured amount? Reinsured amount is 80 lakhs. So 80 lakhs divided by 4 crore multiplied by loss amount is 20 lakhs. So it will come up 4 lakhs. So loss payable by reinsured will be 16 lakhs. See, reinsured, they are asking reinsured. Why reinsured means insurance company. Now here from reinsurer we are taking 4 lakhs. So 16 lakhs will be paid by the insurance company. So answer will be 16 lakhs if they are asking you the reinsured. If they are asking you reinsurer, then your answer will be a 4 lakh. Any doubt in this question? This is a similar question which I explained in the previous examples also. Or do I need to explain this again?
Yes, sir. Please repeat it.
Okay. See, here if you go step by step, what was first, when such question is coming, first you have to know how much risk is ceded. Okay. Now to know that, first check what is the retention. Here retention is 10 lakh rupees and treaty is of 8 lines.
8 lines.
Okay. So 10 into 8, 80 lakhs is a ceded. 10 lakh kept, 80 lakh ceded. Sum assured was 4 crore. Now remaining 3,10,000 are again there. If there is a surplus treaty, it will go to the next surplus treaty. But if there is no surplus treaty, that 3,10,000 will come back again to the insurance company. Okay. Now, how much is with the insurance company and how much is with the reinsurer?
3 lakh. Sorry.
3 crore 20 lakh with insurance company and remaining
Correct.
80 lakhs with the reinsurer
Correct.
company.
3 crore 20 lakhs means 10 lakhs plus 3 crore 10 lakhs. 3 crore 20 lakhs is with the insurance company and 80 lakhs is with the reinsurance company. So if you go by the ratio, then what will be, what is the ratio over here? 4:1, right?
Yeah, 4:1.
4:1 is becoming a ratio. If you go by the ratio, then now if loss amount is a 20 crore,
20 lakhs.
so
20
16 lakhs with the insurance company and 4 lakhs with the reinsurance company. Is it clear?
Yes,
by
sir.
that way also you can solve, or another way I have mentioned here, like the simple formula you keep in mind. Reinsured amount is cession divided by total sum assured into loss amount. Now reinsured amount is 80 lakhs, we have seen 8 lines, and total sum assured was 4 crore. So 80 lakh divided by 4 crore into loss amount 20 lakhs. If you do that, then again you will get a 4 lakh will be the answer. Got it? So by any method you can go and you can find out the answer. Again, the similar examples are here, so I'm not taking that. Directly moving towards the next slide, which is a difference between quota share and surplus treaty. We have seen both the type of reinsurance. In quota share, we have seen that it was denoted in terms of percentage. Surplus treaty is mentioned in terms of amount, or which is a line. Okay. In quota share, every risk has to be insured. In surplus treaty, sum insured less than line, no reinsurance arrangement. See, we have seen that even a 1 rupee risk will be transferred in the quota share. If it is a 20% risk, 20% quota share. So in 1 rupee risk also, 20% will be ceded in the quota share. But suppose that risk is coming below the retention amount, then it will not be transferred to the reinsurance company. Say in that previous cotton example, that retention was 10 lakh rupees. Okay. Suppose the risk is of 8 lakh rupees. So entire 8 lakh will be kept by the insurance company. And in that case, there will be no division. Okay. Because entire is kept by the insurance company. And also 100% is with the insurance company. So no division. So, but remember here that if risk is coming below the sum insured, then it will be kept by the insurance company and there will be no reinsurance arrangement for such a risk in surplus treaty. Okay. Now bad risk will be for bad risk we arrange a quota share and good risk we arrange a surplus treaty, so that good risk can be kept, smaller good risk we can be kept with the insurance company. Heterogeneous kind of risk will be there in a quota share and homogeneous kind of risk will be there in a surplus treaty. Now we are moving towards the non-proportional treaties. Now see, in proportional treaties we have shared a risk in a proportion, but now in non-proportional treaty we are sharing, there is no such proportion. So what, first of all you understand that this is not a risk sharing or a sum assured sharing. Okay. In non-proportional treaties we are sharing losses or claims. not a risk or sum assured. Risk and sum assured are related with the proportional treaties, but losses and claims are related with the non-proportional treaties. So non-proportional treaties are not related to with the original premium, because see, in each and every risk, if sum assured is not shared, there is no proportion, then how can we share the premium? Okay, so then how premium are decided, that I will explain later. Okay, and so non-proportional treaties are coming into picture only in the cases of losses or claims. Okay, so non-proportional treaties are dealing with the claims only. Now, excess of loss treaty here, this is non-proportional treaties are also called excess of loss treaty. There are various kinds of this. Now, under excess of loss treaty, reinsurer agrees to indemnify reinsurer for losses that exceed a specified monetary amount identified the reinsured. Such an identified amount is known as a deductible, excess, priority, or underlying or a layer. Like you must be knowing that the policy which we are issuing to the insurer, to particular insured, in that policy you must be aware that we are keeping some excess. Now what is happening? Suppose in a particular policy there is an excess of 10,000 and there is a loss of 9,000. What will happen? Entire loss will be borne by the insured. Okay. Likewise in the insurance also, what is happening? Whatever excess is there, if loss is coming under that, then that entire loss will be borne by the insurance company, will not transfer to the reinsurance company. Say example, aggregate limit is 10 lakhs with deductible of 5 lakhs, then it will be deducted as a 10 lakhs excess of 5 lakhs. Now what does this denote? That 10 lakh is the cover provided by the insurance company after 5 lakhs. So if there is a loss of say 3 lakhs rupees, okay, how much will be paid by the insurance company? How much will be paid by the insurance company under excess of loss treaty?
Full by insurance company, nothing by reinsurance.
Correct. Because if loss is coming under deductible or excess, entirely it will be paid by the, by whom? Insurance company. Not in the case of the which surplus treaty. In surplus we have seen that even the loss was below the retention limit, still it was shared. Okay, so here entire loss will be paid by the insurance company. Now suppose there is a loss of say 11 lakhs. How much will be paid by the insurance company and how much will be paid by the insurance company?
5 by the insurance company and 6 by
5
reinsurance.
and 6.
Correct, 5 and 6. If there is a loss of say 20 lakhs, then which company will pay how much?
10,
5,
10.
10 and 5 will
10,
be
10.
transferred to him.
10, 10.
10, 10.
Correct, 10, 10. Why 10, 10? Because 5 lakhs first will be paid by the insurance company, then 10 lakhs will be paid by the insurance company, then again 5 lakhs are there, it will again come back to the insurance company. So 10 lakhs each will be paid by the insurance company, each company. So likewise the examples are given here. Aggregate limit of 10 lakh with a deductible of 5 lakhs will express this one, and the examples I have already taken. So you can understand by this example whatever mentioned here. Now there can be a risk excess of loss. There are various types: risk excess of loss and cat excess of loss. So going one by one, first one is the risk excess of loss. Now what is the risk excess of loss? So each and every risk here, the slide was prepared earlier, that's why it is mentioned 5%, but now there is a 4% of the obligatory treaty. Okay, this is just one simple arrangement, this will not come, just an example, but you understand what is the risk excess of loss. So each and every risk will be in reinsured. It's called a risk excess of loss. Like so in which cases that risk excess of loss will be required? Which portfolio? I already given example also, where and means if you see the losses will be smaller, like I told you the health claims losses are smaller, okay, frequency is more. So in each and every loss if you want to cover, so then risk excess of loss, in risk excess of loss what we are doing, in each and every losses excess will be there. If the excess is crossed, the amount will be recovered from the reinsurance company. If the loss is below the excess, then there will be nothing recoverable. I will give you one example after explaining cat excess of loss, then that will be self-explanatory. Then cat excess of loss. See, in risk excess of loss, what we have seen that each and every risk is risk will be means in each and every risk there will be a share of the reinsurance company if loss is beyond the beyond deductible or beyond excess. Okay, say 20 crore excess of 10 crores. So whenever the loss is coming beyond 10 crores, so in that each and every losses, reinsurance company will pay more whatever loss is surpassing more than the 10 crore rupees. Say loss is 11 crore, 1 crore will be paid by the reinsurance company. If loss is 20 crore, 10 crore will be paid by the reinsurance company. Loss is 15 crore, then 5 crore will be paid by the reinsurance company. So in each and every losses, whenever losses is surpassing that limit, then that amount will be paid by the reinsurance company. Now in cat excess of loss, it is not like that in each and every loss. Now what we see, and there can be a many losses. So here when more than one risk is involved, then that will be secured to the catastrophic losses. So if there is a cyclone or if there is a heavy rain, so there is an earthquake, in such a catastrophic event, it is not possible that only one policy will hit. There are so many policies, and that will be that will hit by that cyclone or catastrophe. So in such a cases, what will happen? Your losses will be smaller. Maybe say uh, only 5 lakhs rupees. So say there is a motor insurance. Okay, motor insurance say 5 lakh, 8 lakh, 10 lakh, likewise only. But if you combine, there will be accumulation in a particular city. If there's a flood in, say, like a Chennai floods. So in Chennai floods, you must have seen there are so many vehicles were drowned. So what happened? Although losses were of 8 lakh, 10 lakhs, 15 lakhs only, but the overall impact was huge. So to avoid that, we arrange a catastrophic excess of loss. Now here, one compulsion is there. There is a 2 risk warranty. Now, what is a 2 risk warranty? At least 2 risks should be involved in the losses. Suppose there is a earthquake and only there is an impact to one only policy. So then we cannot cover it from the cat excess of loss. We can cover only from the risk excess of loss. So now I'm giving an example here. From this example, your doubt will be clear how these two are working. Say there are the 5 losses in one event. One is 1 crore, one is 2 crore, one is 3 crore, one is 4 crore, and one is 5 crore. So total 15 crore losses were there. 5 losses were there at one event. Now we have arranged 2 type of excess of loss. One is a per risk, another one is a cat excess. Now per risk is a 5 crore excess of 3 crore, and cat excess is a 10 crore excess of 7 crore. Now what happens? Suppose if you take this example, if it is a 5 crore excess of 3 crore, now we will not combine it together. In risk excess of loss, we will see each risk separately, and we'll check whether the excess is crossed in that risk or not. Now in first risk, 1 crore is there. How much will be paid by the insurance company? In 1 crore? Nothing, because 3 crore was our deductible. In 2 crore, what will be paid by the insurance company? None.
Nothing.
In 3 crore? Again? 0. In 4 crore?
1 crore.
1 crore. Because 3 crore was excess, so 3 crore will be paid by the insurance company and 1 crore will be paid by the reinsurance company. In 5 crore?
2
crore. Okay. So in this, in total loss was 15 crore, but we could recover only from 2 risks of 4 crore and 5 crore only, because up to 3 crore, these 3 risks were below the deductible. So only we could recover 3 crore. So if there is only one, there could be only one arrangement of per risk excess of loss. So we could recover 3 crores only, and 12 crore needs to be paid by the insurance company itself. Okay. Now there can be another arrangement, say cat excess of loss or per event, which is another name for the cat excess of loss. In that, so say there is a arrangement of 10 crore excess of 7 crore. Now what is happening? 10 crore excess of 7 crore. Here, what will happen? do we check each and every risk? In 1 crore, how much will be paid the insurance company, or 2 crore, how much will be paid? Do we check each and every risk?
Total of all
No.
loss.
No, we will check the total in particular event. Now, what is the total loss in that particular event?
15.
15 crore.
15 crore. So in 15 crore, what is our deductible or excess?
7 crore.
7 crore. So we will keep 7 crore. Means 7 crore will be paid by the insurance company and 8 crore will be paid by the reinsurance company. So you must have understood the difference between two. So by which contract, how that treaty will be triggered. Okay. Now, if sometimes it may happen that we may arrange both treaties, per risk XL also and catastrophic XL also. If both are arranged here, so in one treaty we can recover 3 crores, in another treaty we can recover 8 crore. So we can recover 11 crores, and then the net impact will be 4 crore only to the insurance company. But in that situation, we have to pay double premium to the per risk also and to cat XL also we have to pay the premium. Okay. Now stop loss. This is the third kind of XL. Now in stop loss reinsurance, we are arranging it for the high frequency and low severity claims. It is based on the GNPI. Okay. Now what is the stop loss cover? Now see, we have seen risk XL or cat XL. In that we have seen that it is a particular amount, say 5 crore excess of 2 crore. Okay. Now in stop excess, we are protecting our losses to particular percentage. Say up to a particular percentage losses are there. So say we can say that 110% or 90%. So if 90% losses are there, it will be paid by the insurance company. 110% losses are there, it will be paid by the reinsurance company. But to know that, we should be aware of two things. One is the GNPI, gross net premium income. Okay. And second one is losses. Why these two things are important here? To calculate the claim ratio, because in stop loss cover, claim ratio is important. Now this kind of arrangement is made in health, aviation or liability kind of policies. Here this cover will be triggered on a particular attachment point. Say like here example is there that reinsurer to pay all losses above 110% up to 140%. What does this mean? That till the 110% ICR, everything will be paid by the insurance company. When it triggers, then the insurance company will pay, but up to the 140% only. Now there is an example that total premium is 100 crores and total claim is 150 crores. Now tell me, in this case, how much? How will you decide that how much will be the recovery? In a particular this example, 110% up to 140% will be paid by the insurance company. How much will be the recovery here? What we see? First of all, you should be aware of the claim ratio. Now, what is the claim ratio? 150 divided by 100. So, claim ratio is how much? How much is the claim ratio
150.
here? Right, 150% is the claim ratio.
50%.
Total 50% will be recoverable. Everything,
No,
everyone
sir.
is thinking like
No.
that only.
No, sir.
No, sir.
It should be above 110.
So if there is a, so in that 150 crores, how much will be the recovery? Tell me.
So 40 crore.
40 crore is the recovery.
No, 30 crore.
30 crore.
We can recover only 30 crore because it is limited up to 140.
Correct. So if premium is 100 crore, so up to 140% means up to 140 after 110. Okay. So first 110 will be paid by the insurance company, then 30 will be paid by the insurance company, and the remaining 10 again will come back to the insurance company. So here the recovery will be 30 crores only. Okay, understood this one? Shall I move forward? Okay.
Yes, sir. Yes, sir.
Now next, gross net premium income, GNPI. Now in GNPI you can see that gross premium received less premium returns, cancellation, premium of excluded risk and premium pre-insurance. Why the GNPI is important here? To calculate the loss ratio. Sometimes they will not give you the loss ratio. They will provide you these things. Okay, premium received, premium return, cancellation. In 1 to 2, they will directly give GNPI and say claims amount. On that basis, you can directly calculate. But maybe for the higher scales, they can give these figures. Okay. Now see, gross premium received means the total amount of premium received by the insurance company. Premium returns, sometimes there can be there can be a refunds of the premium, so that will be reduced from it. Cancellation, sometimes policies are cancelled, so that will be reduced from it. Premium on excluded risk, sometimes what happens in treaty, everything is not covered, some part is not covered, say like terrorism is not covered in that treaty, so the premium of a terrorism will be deducted from it. Then premium on the reinsurance, suppose there are some other insurance contract like surplus or quota share, so some premium we have paid to the quota share or surplus also, so that part will be reduced from it, and whatever balance will be there, that will be GNPI for that stop loss reinsurance. Okay. Now quickly tell me, in this example, reinsurance agrees to cover losses to the extent of 90% over reinsured net return loss of 80% subject to a maximum of 130%. Now in each and every case, tell me how much will be the recovery. You just tell me the recovery only. Okay. Tell in 2007 loss ratio 68%. Tell me how much retention, how much recovery.
No recovery.
2007, no recovery. 2008, no recovery.
Correct, because it is a below the underlying limit. So 16% will be paid by the insurance company. In 72%, tell me now.
2010,
No retention.
20%.
No
No
recovery.
recovery.
85%. 85%.
5%. 5% recovery.
5% recovery. Okay.
4% recovery.
Okay. 4% recovery.
Yeah,
Any other
4%.
answer?
4%. 90%.
5%.
5%, 4%. Two options are there. What is there? Is there any third and fourth option also there?
4.5.
4.5. Okay, we got 4, 4.5, and 5. Any, and fourth one is a none of the above. Now tell me,
4.5.
how many of you think 4%? 4.5. Now see, you read it carefully. They are saying that cover losses to the extent of 90% over reinsured's net retained loss of 80%. Okay, so what they are covering, subject to maximum of 130%. So they are, see, up to 80%, everything will be paid by the insurance company. Now from 80 to 130, there is a reinsurer will be involved, but in that 80 to 130, in that 50% range also, they will be only 90%. It is mentioned that 90% will be paid by the reinsurance company. So whatever their share is coming in that 50% range, 80 to 130, they will pay only 90%, not that whatever is coming to their share. So in 85%, what happened? First 80% is paid by the insurance company. In balance 5%, that 90% will be paid. So 90% of the 5 will be 4.5. So 4.5 will be paid by the insurance company, and again 0.5 will go back to the insurance company. So 80 plus 0.5, so 80.5 will be paid by the insurance company, and remaining 4.5 will be paid by the insurance company. Next is example 100%. Now in this example, I need 100% correct answer.
18% recovery.
18%.
Okay, any other answer? Please try. Even if it is wrong, then also try to answer, because if you are giving wrong answers, then you will not give wrong answer in your examination. For sure.
So retention will be 82% and reinsurer will be 18%.
Everyone is on the same page? Everyone is on the same page?
Yes, sir.
Yes, sir.
Okay. For 130, now tell me. $130.
45.
45.
45%.
80 plus 50. 45. In 150%.
45.
In 120,
85 and 45.
Right. Again, 45 only. Why? Because the maximum limit is 130. Okay. So 80 insurance company, remaining how much? Remaining 50% only. 130. Na? So up to that 50% will be bear by the reinsurance company. In that also 90%. So 45 will be bear. Now 45 will be bear there. So 5 from that and again remaining 20. So 25 will come back to the insurance company. So 80 plus 25, 105 plus 45. Am I clear? Okay, shall I move forward?
Yes, sir.
Yes, sir. So for 150, it should be 150, na? Because 90% of
150 it should be
above
how much?
is 50 होना चाहिए ना last वाले का.
No, no.
45.
Because 90% of the
Minimum
losses
130
in their
percentage.
share will
So
not take.
90% of share to 145 हो जाएगा. We will not get.
See, 80% is kept first. Go step by step, then you will understand. We'll go first. 80% will be kept by the insurance company. Is it okay? Next step, from 80 to 130. That is the capacity or given by the capacity support given by the reinsurance company. Okay, so 80 to 130 only. So it is a 50. Okay, so in that up to that 50 only they will pay. Will not see another 20. That another 20 is directly going back to the insurance company. In that 50 only 90% you will calculate. So it will be 45. Okay. Don't see that up to 130. So up to 50 will not see like that. From 80 to 130 that range is provided by the reinsurance company. Got it? Okay. Is it clear? Shall I move forward?
Yes, sir.
Okay. See, answers are given here. See, 80, 45, 25. Like we just discussed. Fine. Okay. Now, stop loss ratio. One example is there. Calculate the recovery from reinsurer. Now, see, in another way they are asking. GNPA 2,100 crore.
Please go to the previous slide once, sir.
Okay. Okay. What is the doubt? Any doubt here? These are answers only which we you have already answered.
Okay, thank you, sir. Thank you, sir.
Okay. Okay. Now tell me here what is the see
Yes, sir.
what is the recovery in this particular example? Tell me. What is the recovery?
585.
Okay. Any other answer? Try to solve, even if it is wrong.
27%. 0.85.
27%. Tell it in terms of amount.
543.
82.5.
82.5. Okay. Let us move forward and see what is the answer. See, GNPI is 2,100 crore. Loss is 1950. So reinsurance pays if losses exceed 65%. So first of all, what you should know, GNPI 2,100 crore, loss is 1950. Reinsurance pays if losses are uh, uh, above 65%, right? So first you should know that in that what is the loss ratio? 1950 divided by 2,100 crore.
92 point something.
92.5.
Yes.
How much is the loss ratio? Or simply in this example particularly, because see different the question will have different way to different ways to solve this problem. Okay. Now here simply 65% will be paid by whom? This is stop loss rate of 65% on above. Then What does it mean? Reinsurer will only pay if losses are above 65%. So up to 65% will be paid by whom? Insurance company. So 65%
Reinsured.
of, right, 65% of the losses is how much? 1950. Okay. So you can go
1365.
here. Yes. Are you trying to solve it or shall I explain?
It's easy, no, sir.
1365.
1365. How do we calculate this? Loss is 1950, but we calculate the loss ratio on GNPI. So 2100 multiplied by 65%, it is 1365. Don't multiply 65% with the 1950. It should be multiplied with the GNPI. So two ways I am telling you here. Number one, as it is shown here, you can see 2100 into 65% will be paid by whom? By the insurance company. So 2100 into 65% is at 1365. Total losses are 1950. So 1950 minus 1365, it will become 585. There's another way that you calculate the loss ratio. Okay. Now what is the loss ratio? This is the simplest one which I have explained. But another way, if you are not remembering this one, so 1950 divided by 2100, you will see
92.85.
92.85%, right? Minus 65%. So 27.85% will be paid by the reinsurance company. You apply this on your this one, so you will get that much. So again, that is one way, but I think this is a simpler one. You go by this way only. GNPI multiplied by the loss percentage, you will get the insurance company share. You deduct it from the losses, you will get the balance amount, which is the recovery. Okay. Calculate recovery from reinsurer if GNPI is 5,000 crore, incurred claims are 4,500 crores, and stop loss treaty 75% and above, and maximum 600 crore. So
Easy.
how much will be the recovery here?
$600.
600. Okay. Anyone else?
150.
150. Okay. See, stop loss treaty is of 75% and
600.
above.
600.
600. Correct. Okay. See what is happening? 75% and above. So either 75% will be deducted from the total losses, or you can calculate this one. Okay. So 75% of GNPI is coming 3750, 4,500 minus 3750, 750 should be paid by the insurance company, but there is a capping of 600 crore. That's why answer is 600. Okay. Now, aggregate excess of loss cover. Now, it is a similar to stop loss only, but only the difference is that in stop loss we have seen the percentage. Okay, but here the aggregate excess limit is given, which is denoted in terms of amount. Okay, so up to that is the difference. So applicable to specific set of risks, it is and here can be applicable to the insurance whole book of account covering all LOBs also. Next one is a pool. I already explained that sometimes it is not possible to means there can be a decline of a particular risk. So to avoid that, maybe regulator or the government may instruct to the companies to form a pool. I'm talking globally, not about India only. In different countries, there can be a different situations. So here, what is there in the pool? It is nothing but a sharing of risk in a particular proportion. In means every companies are contributing in the pool, and then they are sharing the losses accordingly. So you must be aware that there is a terrorism pool, nuclear pool, marine hull pool. There can be various pool can be formed. There was earlier motor TP pool that is dismantled now. Then again there was a declined risk pool, which is also declined now, dismantled now. Okay, and they in for every every pool there is one administrator. Mostly in India, the administrator is a GIC, which is appointed by the IRDA. The mostly for this pool, the administrator is a GIC. Now there are two terms. One is a risk attaching basis, and another one is a loss occurring basis. Now, what is the risk attaching basis? Suppose suppose a policy is underwritten in the treaty period, then the loss is payable even if the loss is occurring after the treaty period. Okay. And what is loss attaching basis? I will just give you an example. By that example, you will understand what is the difference between those two. In loss attaching basis, what is happening? Whenever policy is underwritten, but if loss is occurring in the policy period or treaty period, then loss is payable under this arrangement. Now, I will give one example. Say there are two treaties. Okay. One is 24-25 and 25-26 financial year treaties we are taking. Or so 1st April 24 to 31st March 25, the treaty was with the GIC. Okay. In 1st April 2025 to 31st March 26, the reinsurance is changed and the treaty is with the Swiss Re. Okay. Now 24-25 GIC Re, 25-26 Swiss Re. Now what has happened? Suppose one policy was underwritten on 1st of January 2025 and loss occurred on 1st December 2025. Understood this example? Okay. Now in this, suppose risk attaching basis is there. So in this, who will pay to the insurance company? GIC will pay or Swiss will pay?
GIC repays.
GIC will pay, because risk attached means policy underwritten was in the treaty of 24-25. So when we see the risk attaching basis, we see when risk is underwritten or when policy is issued. So in this case, the losses will be recovered from the GIC. Now, if it is a loss attaching basis, okay, in loss attaching basis, it will be paid by the Swiss because loss happened in Swiss Re. Got it? Understood the difference between the risk attaching and loss attaching? Okay. So this is the difference between the two. Now, XOL cover and factors affecting the rate. Now, see, while explaining the proportional treaties, I explained that the premium is shared in the proportion. But now there is no such proportion in the risk XL or cat XL, means any kind of excess of loss treaties. So how premium will be decided? So the premium will be decided beforehand based on the past experience. They say some particular premium rate. Say we will take 5% premium rate. Okay. So after the now see, beforehand you don't know what will be your GNPI. GNPI will you will come to know GNPI after the end of the treaty only. But there will be some estimated GNPI. So what happens? Then there will be there is a concept of a MINDIP. MINDIP means minimum and deposit premium. So in MINDIP, what is happening? That example I will take later on. MINDIP also, and that rate decided also. Then what is happening if there will be lesser premium or more premium, that I'll explain. So MINDIP is minimum premium to be taken. That you just understand for now. I'll explain it later again. Now here factors affecting the rate of XOL cover. Now when that rate is decided, how it is decided, it depends on certain factors like level of excess or deductible point. If the excess point is lower, then rate of XOL will be lower or higher? What do you think? Higher, because most of the risk is passing towards the reinsurance company. So the rate will be the higher. Limit and exposure to the insurer. If limits are higher, exposure is higher, then rate will be
Higher.
It will be, of course, higher.
Lower.
No, higher. The limit, more limits are provided, though then exposure is more. So the rate will be higher in case of more or higher exposure. Class of business, it will depend on the how if that line of business is there. If it's a profitable one, then lower rate. The loss making will be the high rate. Exclusions, there are so many exclusions under the treaty, then rate will be lower. And there are limited exclusions, then the rate will be the higher. Then past experience of the treaty, if past experience is a profitable one, then rate will be the lower. If past experience is not a profitable one, then rate will be the higher. So these are the determining factor. Now, burning cost. What is the burning cost? Burning cost, it is the means cost to be recovered to cost to be recovered in the terms of premium on the basis of past experience. Say if we have paid 8 crore in past, so at least we should recover 8 crore. After that, we will load some our management expenses and some other administration and other expenses on that. But before that, first we have to we need to calculate what will be the burning cost. Okay, so to calculate a burning cost, what we take all the losses. All losses means the paid plus outstanding losses will be your total losses divided by TT period GNPI multiplied by 100. This is your burning cost. Okay, but now if you see the screen, I have again divided by 70. Why it is divided by 70? It is a loading for your acquisition cost, management expenses, catastrophic reserve, profit element. This is in the range of 30%. Okay, we assume all these will come under 30%. So because of that, we are divided by the 70%. 70% division means the loading of 30%. If in example particularly they are saying that 25% loading, then you have to divide it by 75, not 70. Okay, so 100 minus the loading percent will be your this division factor. Okay, now Pareto curve. Now what is a Pareto curve? It is it is a curve drawn on the basis of the losses. Okay, now if you see here in this Pareto curve, you will find that there are two lines are drawn. We are taking some 2 points. Which 2 points we are taking? We are taking one is a deductible and another one is a capacity provided. So if you see that 30%, you will find that 56.8% losses are coming under the range of 30%. So if insurance company is deciding to keep 30% losses, so they need to pay 56.8% losses by themselves. And if reinsurance company is providing the cover of 80% above the 30%, so that range from 30 to 80, that 50% range, in that you will find that 94.9% losses are coming under the 80% loss ratio. Okay, so when we are charging to the insurance company, means reinsurance company charging to the insurance company, they will see their exposure. Now what is the exposure here of the reinsurance company? Their exposure is between 56.8 to 94.9. So 94.9 minus 56.8, that is 38.1% is the exposure to the reinsurance company. So reinsurance company will charge 38.1% of the total premium. So here see, for example, 50 crores excess of 30 crores cover. Here we have seen 94.9% losses falling under 80%. When if they are asking you to take a total limit, not only that 50% range, all they are giving the cover of 50 crores. Okay, 50 crores on 30 crores, but the capacity is 80, so that's why we are looking 80%. Okay, and 80% losses are coming under 94.9%, 56.8% losses coming under 30%. So we'll take the difference. So 38.1%, whatever premium we are charging, in this case the premium is 1 crore, so 38.1% of that 38.1 lakhs will be charged by the insurance company to the insurance company. Now MINDIP, which I was going to explain you. Yes, in doubt?
Yes, sir. Can you please repeat the previous slide, sir?
Okay. What is your doubt?
No, this 80% you have made, no? I think it was a bit faster. Can you please?
Okay. There can be a situation that cover is granted 50 crore excess of 30 crore. Okay. Now we will see how much exposure to the insurance company here, up to the 30 crore losses, right? So up to the 30 crore, what is the probability of losses? It is 56.8%.
Yes,
So,
sir.
so that losses will be paid by whom? Insurance company, right?
Yes, sir.
Now, beyond this, what is happening? 80%. Beyond this, 50 crores will be paid by the reinsurance company. Now that 50% will not be from 0 to 50. It will be 30 to 80, right? So we
Yes,
will
sir.
see up to 80% how many losses are coming here. Up to 80% is coming. 94.9% losses are coming, right?
Yes,
Is
sir.
this clear?
Yes, sir.
Okay. So 94.9% exposure is there. But out of that 94.9% losses, how much will be paid by the insurance company?
56.8.
Right. So 56.8% will be beared by the insurance company. So the actual net exposure to the insurance company is how much? 94.9 minus 56.8. Right?
Yes, sir.
So that is
Yes, sir.
38.1%. So if exposure is 38.1%, they will charge a premium of 38.1% on GNPI. So if premium is 1 crore, 38.1% is coming 38.1 lakhs. Understood this one?
Yes, sir.
Okay. So moving forward. Yes. Any doubt?
No, sir. That's it.
Okay. Now MDP. MDP is a
Sir,
minimum deposit premium. Okay.
sir,
Now as we
sir.
have discussed that rate is determined, but even rate is determined, but we are not aware what would be the premium. Okay. So whatever rate is determined, in that we ask as a means insurance company asks to the insurance company that although my rate is say 90%, my rate is 5%, 10%, whatever it is. Okay, you need to pay 85% of the premium in advance or 90% of the premium in advance. So that premium paid in advance is called as a minimum deposit premium, MDP. Okay. Now what happens if the premium is more, actual final calculation is more, then the balance premium will be paid by the insurance company to the insurance company. But if the final premium is coming lower than the MDP, then what will happen? Will there be a refund? Will there be a refund or not? If say MDP was 80 lakhs
No,
and
no.
final
It
payment
will be
premium is
retained.
70 lakhs, will 10 lakh be refunded by the insurance company to the insurance company? Will it be paid?
No, no, no
No,
refund.
because in name only you can find it is a minimum deposit premium. So minimum at least we will take this much. Okay, so that is the thing. Now adjustment premium, as I explained that suppose MDP is 80 lakhs and your final premium is coming one CR, that 20 crore will be paid by the reinsurance company, insurance company to the reinsurer. That is called an adjustment premium. That what is the difference between the actual premium minus MDP is called a adjustment premium, which will be paid at the end of the treaty period. Okay, but if your adjustment premium is more than the MDP, then there will be a no refund. Now there are some examples. Now in this actually directly I have taken a answer slide. Previously I had a question slide also. Okay, example first. ENPI is 50 crore. Okay, rate is 10%, cost is 5 crores. MDP is 90%. See, now in this MDP is 90%. They will provide you ENPI, rate, MDP. Okay. And yes, ENPI is estimated net premium income. Okay, estimated premium income. Then rate is given. MDP percentage will be given, and premium income will be given. Premium income is final premium income. Okay. Now they can ask you to calculate the adjustment premium. So how would you do? First, you have to apply the rate on ENPI. In first case, rate is 10%. So 50 crore into 10%, your cost is 5 crore. So we are estimating premium of 5 crore rupees, but MDP is 90%. So we will pay 4.5 crore in to the reinsurance company. Although we are not paying everything in advance, we are paying it as in quarterly only. So 90% will be paid by the insurance company to the insurance company, which is coming 4.5 CR. Okay. Now premium income is coming 55 crore. So actual cost. Now how will you calculate the actual cost? Your rate into premium income. Rate is 10%. 55 crore into 10%, it is coming 5.5 crore. Now in this case, your actual cost is more than the MDP, right? MDP you paid 4. CR, so adjustment premium is 1 crore. Got it? Moving forward to the next example, in say marine excess of loss, ENPI was 30 crore, rate was 20%, and MDP was 90%. Calculate the adjustment premium. Now first we will apply the rate on ENPI, then we'll get a cost. That is the estimated cost is 6 crore rupees, but we'll pay only 90% of it as a MDP. So 6 crore into 90%, 5.5 crore will be paid. Now in that, premium income coming 28 crore. So actual cost will be 28 crore into 20%. It is coming 5.6 crores, which is more 20 lakhs from the estimated one. So 20 lakhs means 0.2 crore will be paid again by the insurance company to the reinsurance company. Now in the third case, if you go similarly, 30% on 20 crore is coming 6 crore. MDP is 5.4 crore coming, but premium is 15 crore. 15 into 30% is coming 4.5 crore. Now here, if you see, the actual cost is less than the MDP. So there is a provision of no refund. Fine. In motor excess of loss, again 40%, 40 crore into 10%, 4 crore. Then MDP is paid 3.6%, 90% of the 4 crore. 3.6 crore is paid. Then premium income is 39 crores. Actual cost is 3.9. So it is 0.3 will be paid again to the additional premium. Any doubt in this? Or I think that table is self-explanatory, isn't it? Only
Yes, sir.
the problem will be in the third case. Yes, it is clear. Or any doubt?
Sir.
Yeah, going forward. Now commissions. Now commission is offered by the reinsurance company to the insurance company. They can be a flat commission, maybe fixed percentage is given 5%, 6%. Sliding scale commission. Sliding scale commission will be based on the loss ratio. Now basically you will find this kind of commission in a Excel treaties, not a proportional treaties. Sliding scale commission. Flat commission you can find in maybe proportional treaties. Profit commission again in proportional treaties. Flat commission is also there. Even sometimes if it is profitable, then profit commission can also be provided, even both the rates. So that will be a three kinds of commission. Now these we already discussed, so I'm not taking again. Acquisition cost is the expenses relating to the acquisition of a business. Administrative cost, the cost of administration excluding acquisition and a claim settling cost, annually as of 12 months. Border is a detail of the a particular thing. Okay, maybe there can be a premium border or claim border. In premium border, everything related to the underwriting will come here. That say risk, like LOB, then insured name, then sum insured, then premium rate. Likewise, all the premium related things will come in that. In claims border, claim related things will come. That who is the insured, how much loss is incurred, what is a PML, what is the estimated loss, all these paid losses, all claim related things will come under the border rocks, and this we are sharing with the reinsurance companies. Burning cost, we are already seen the burning cost, but remember that burning cost is determined on the basis of the experience rating, because we see the past losses to calculate the burning cost. That's why it is called the experience rating. So premium border and claim border are shown here. The various fields are there. They may ask you what is the not part of the premium border which of the following is not a part of a claim border box? That question might come. So you just see what are the contents coming under which border box. Now there are some terms in that I'm taking clauses also together. Commutation clause. This is a clause provides for discharge of present and future commission between reinsured and reinsurer by an estimated settlement. Means what is happening at the end of the treaty period. Now I had given you the example, right? Like say that 24-25 treaty and 25-26 treaty also there. Suppose on 31st March 2025, there are certain losses outstanding, okay, or certain policies are still in force. So if the treaty needs to be closed, that losses should be bear by the JSC in that cases. So if JSC don't want to do that, so particular amount will be paid by the JSC to the insurance company. So that will by which the future liability will not be there. So that is called a commutation clause. Next one is the ceding commission. That commission will be paid by the insurance company. ORC. Now ORC will be a smaller commission, because what happens in particular this, like say marine hull, likewise this one. What is that? Premium is paid net of administration expenses. So if administration expenses are already deducted, so that only certain parties paid as a commission. So that will be ORC or the overriding commission. Cut through clause we already explained. Earned premium, proportionate premium for the reinsured period. You must be knowing that we are calculating in our day-to-day life also what is our earned premium. There are different methods, like 1 divided by 365 method is also there, and some other methods 1 divided by 8 method is also there. 12th method is also there. So by different methods, different kind of earned premium is calculated. Follow the fortune clause. Follow the fortune clause means the reinsurer will follow the fortune of the insurance company. Okay, so if claim is paid by the insurance company, it will be again payable by the insurance company. They will not question that. Fronting means insurance company is writing a risk just for the sake of transferring entire risk to the insurance company. Means whatever risk is underwritten, 100% risk will be transferred to the reinsurance company. Not even a single percent will be kept by the insurance company. And that fronting is not allowed by the IRD in Indian market. Ground of loss, it is a gross amount of loss occurring to a reinsured beginning with the first dollar of the loss and after the deduction required by insurance agreement. Entire amount of loss including deductibles, but net of salvage and recoveries coming under your ground of loss. So here we are only not taking the means it is including a deductibles, net of salvage and recoveries. That also will be the part of your ground of loss. This is total loss, you can say another word. Ultimate not net loss, it will be a recoverable loss from the insurance treaty. So in that what we do, it is a loss including survey fee, legal fee, less recoveries from other insurance. So the losses and losses related expenses, okay, say surveyor fees, legal fees. Suppose a particular employee is traveled for the settlement of some losses. So if it will be loss related expenses, that will come under your this gross loss only. That will be part of the loss related expenses. So that will be added in that. But if a particular employee is traveling for the day-to-day for transaction, that will not come, because this is your administrative expenses. So administrative expenses will not be added, but the loss related expenses will be added under this to come towards the gross loss. And from that, less other recoveries will be deducted. So other recoveries means there can be some other insurance contract, from that some losses will be recovered, so that will be deducted. And what will be the final amount of the loss? That will be your gross loss. So that will be your ultimate net loss, and that will be recoverable from the reinsurance company. SWIFT, full form single window international facultative treaty. Faculty and treaty can ask for scale 1 to 2. Gross direct premium is equals to gross domestic premium minus reinsurance ceded plus reinsurance accepted. Means suppose New India is writing say 5,000 crore, okay, and ceding 2,000 crore. Again from some say Oriental, they are accepting 100 crore. So 500 minus transfer to the JSS, say 200 crore, 300 crore plus accepted from the Oriental, say 100 crore. So your GDP will be 400 crore. Long tail, you must have seen that liability losses, maybe motor TP losses or some other in liability. There can be that losses, maybe public liability or some other liability. In these policies, what is happening? Losses will not be settled immediately. And sometimes even losses reporting will take a time. So these losses, this kind of losses is called as a long tail losses, because the settlement will take a longer time. And because of this only, we are not the clear picture of the treaty will not be there at the end of the treaty. So that we have to see how losses will be reported. Maybe after 1 year that this much will be settled, 2 years this much will be settled. So that adjustment will be done for taking into account what will be your past experience. Okay. Then portfolio, there can be different portfolios: premium portfolio, loss portfolio, or investment portfolios. Premium portfolio means whatever premium or policy underwritten during the year. Loss portfolio is outstanding losses, that is a loss portfolio. And insurers investment portfolio will be insurers whatever investment they have made. Slip is a document setting out the risk particulars in terms of the conditions for which reinsurance protection is out. Who is taking the slip? Broker is taking slip, and they get it signed by the various reinsurer. First, lead reinsurer signs it, then other reinsurers follows the leader. Portfolio we have discussed. Large risk, any risk which is beyond 2,500 crore. In case of property reinsurance, called a large risk, but in case of legal liability, if it exceeds 100 crore, it is termed as a large risk. Downgrade clause, during currency of reinsurance contract, if rating of reinsurance is downgraded, then there is a right of insurance company to cancel the treaty on the basis of the downgradation of the reinsurer. Harsh clause, you will find in particularly in a cat XL, catastrophic excess of loss, because see what is happening, we are considering a particular event, but sometimes what is happening, there is a continuous event. Okay, so in that continuous event, how we will treat as a one event? So if there is a monsoon, we treat 168 hours as a one event. After 168 hours, whatever is will be there, that will be another event. In case of hurricane, EQ, volcanic eruption, civil war, then we treat 72 hours as a one event, remaining will be another one. And that decision of which 72 hours will come in the first event, or next will to another event, will be decided by the insurance company and not reinsurer. Okay. But now you will ask why this then RS clause is important, because even anyway both the event will be paid. If there will be two events, both the event will be paid by the insurance company. But particularly importance of the R clause is in the terms of the excess, because if you treat everything as a one loss, then there will be only one excess. But because of this R clause, what is happening? There is a limitation up to the particular period. After that, there will be second event, so that there will be a two excess will be attracted. And see, actually in the reinsurance contract, there will be a huge excess, less, like say sometimes say 50 crore, 100 crore. So that will be a huge excess for the cat XL. That's why even if it is becoming two losses or two events, then instead of 50 crore, 100 crore will be retention. 100 crore will be bear by the insurance company. That's why this R clause is important. PML error clause. This is also important. Now, what is happening? We have seen that sometimes we risk as underwritten on PML basis. Okay, but if in case sometimes that our estimation of PML goes wrong, in that case, what will happen? That there will be the liability of the insurance company will be increased. Okay, so if liability of the insurance company is increased, in that case, reinsurance company cannot exceed 50% of more than what they are out to be paid. I will give you one example. Like, see, suppose risk sum assured is 100 CR, PML was 50 CR, and there is a loss of 60 CR. Loss of 60 CR. Say there was a 30% quota share, or say 60% quota share was there. Okay. Now in 60% quota share, if PML might not gone wrong, then what could be the losses? What could be the recovery? That maximum loss was 50 crore. So in 50 crore, we could recover only 36 crore, 5, 6, 30 crore from the 30 crore from the reinsurance company. Okay. But what happened? Now loss is 60 crore. Okay. So in that case, now certain extra amount will be recovered from the insurance company. Now what will be that amount? Now first what will you do? We'll see by the PML how much is the recovery. By PML it is coming 30 crore. Okay. 20 crore will be bear by the insurance company. 30 crore will be bear by the reinsurance company. So that will be a 50 crore. But now loss is 60 crore. 10 crore is extra. Now that 10 crore will be again beared by the same proportion. Okay. So 60% will be 6 crores. Okay. But what the clause saying that not 50% more than the liability will be limited to 50%. So see, in that 10 crore, liability is although liability is 6 crore, but that entire 6 crore will not paid by the reinsurance company. Out of that, only 50% means 3 crore will be paid by the reinsurance company. So actual in the PML, the share is 30 crore and plus this 6 crore. So 36 crore will be paid by the reinsurance company in case of the loss of 60 crore instead of 50 crore PML if sum assured is say 100 crore. Okay. Now paid up capital broker, whatever the limits are there that you can go through. So then objective of the insurance program. This is objectives of IRDA.
Please explain again. Sir, please explain.
Sir, please explain again, sir.
Sir, previous the
The PML error card.
brokerage.
PML error card. Yes, sir.
Okay. Okay. See, in a particular risk was of 100 crore. Okay. We estimated a PML of 50 crore. Okay. And the risk is reinsured by 60% with a quota share. Okay, 60% quota share treaty. Now what happened? We shared premium on that basis, but because what happened now? Now if that PML could be the perfect one or correct one, what could be the maximum liability of the reinsurer in that case? In correct PML?
50 crore. 50 crore.
How 50 crore?
30
It is
crore.
60%
Because
quota share.
30 crore.
Sorry, yes. 30 crore, sir. Sorry.
PML is 50 crore, but 60% of that. So what could be the maximum liability? It will be a 30 crore. This much is clear? Okay. Now going towards the next step. Now what happened? In a particular event, there was a claim of 60 crore, not 50 crore. See, our estimate, because that PML is our estimated loss, na? Our estimate may go wrong. So the loss was of 60 crore. Now what happened? Because of this, now the liability is increased to both the parties, to insurer and reinsurer. Now what PML error clause is saying that the additional liability to be borne by the reinsurer shall be limited to 50%. So first they will pay for their original liability. Now what is original liability? 60% of the 50 crore. That is 30 crore. Right? 30 crore will be paid by the reinsurer first. Now what is the additional liability coming? Now remaining loss is 10 crore.
6 crores.
In that again their share is how much? 60 crore. 60%. 60% is coming 6 crore. Is it?
36.
So 36.
Okay. 36 is coming, but we'll not take entire 6 crore here. What we see, we will take a 50% of that only. So out of 6 crore, reinsurer will pay only 3 crores. Okay.
So 33.
So from original liability 30 crore and from additional liability 3 crore. So reinsurer will pay how much?
33.
33. Is this clear now? Got it?
Yes, sir.
Yes, sir. Yes, sir.
Sir, one doubt here. We will take it as a compulsion error clause, or we have to attach this clause for this calculation?
We will attach it. We will attach it. Because
if there is
this
not
will be
mention of
mentioned
any
in the-
attaching of PML clause.
If you'll not attach, then what will happen? Then you have to then liability will be 36.
Sir, I think there is some ambiguity in wording, sir. Can you please go back to the slide? Yeah, sir, here it says reinsurer it should be limited to 50% of the amount that would have been resulted had the PML not exceeded.
Additional, but
So
the
that should
additional
be
liability I'm telling.
ఉన్నాయి
Not
నాకు.
additional
So-
liability. Now, what is additional liability? 6 TR, right? So that's why of that additional liability, we are taking 50%. So 3 CR. Got it?
no, I think it is mentioned as 50% of the amount that would have resulted had the PML not exceeded.
Ah,
ఆడదేనన్నా.
So that
Ah.
will be 50% of 30 crores, huh? No?
no. 50% of the additional liability, which is a 6 CR.
Okay.
Additional liability to be borne by the reinsurer shall be limited to the 50% of the amount that would have resulted had the payment not exceeded. So additional liability we are telling, na. So first we are taking the original liability. Original liability is 30 CR. So we are keeping it aside, and then from the balance liability we are taking 50%. Got
Okay.
it?
పైసలు ఇచ్చేసినావా బేటి? 21 ఉండేనా కరెక్ట్?
Sir, so I have doubt for PML error clause. Sir, PML
What
is
is
there for 50%, like you said. But if the clause is not attached, PML error clause, then it will
We will
affect our
attach.
calculation.
We will attach it because see,
So for
generally,
calculating the questions in exam purpose.
all right.
ఇద్దని.
Sir, please go
So
to
we
the
will attach
trees
it.
or
We
go
will
to
we'll calculate in this way only. We'll answer this way only. Okay.
Okay.
నెక్స్ట్ నెల.
Okay. So
Sir, the broker is sliding. Please go on slow, sir. Please, sir.
okay, we are running very short of the time. Okay, tell me.
Okay,
This-
sir. Thank you, sir.
Okay. Okay, objective of reinsurance program, you maximization of the maximize the retention, then develop adequate technical capacity, secure the best possible reinsurance terms, and simplify the administration business. This is as per regulation 2018. Now then, this is the retention policy which I explained. Compulsory obligatory cession of 4%, but these are the same. Okay. Now in 2000, as per 2018 regulation, we have to submit the board approved program 45 days in advance to the regulator, and then again after the beginning of the financial year within a 30 days. But now there is a change.
నీళ్లు కలిపినావా అందులో?
First, it is 18. First, you understand what is 18 the regulation. Then I will tell you the latest regulation. In 2018 regulation, it was given that every insurance company should submit their reinsurance board approved reinsurance program to the regulator. Okay. Now when they have to submit 45 days in advance. Okay, whatever their arrangement, their planned arrangements are there, they will submit 45 days in advance. Then 30 days after the beginning of the financial year, they will provide the final program that we how they have arranged that. Whatever their planning was there, how they arranged, they will provide it within the 30 days of the beginning of the financial year or beginning of the commencement of the financial year. Then if there is any change, so within 15 days, then that change will also be informed to the regulator. So these three terms were there, but now this rating you just go through because this is just a kind of memorization only. But whatever I was telling, that there is one change, that earlier there was 45, 30, 50, right? But now the time limit of 30 days from the start of the financial year is also changed to the 45 days. So now there is no confusion. Before the financial year also 45 days, and after the financial year also 45 days. So, so 45 is a constant now. Got it? Okay. So there will not be any confusion.
Mute yourself. Kindly mute yourself.
Yes. Hello. Any doubt? Got this one? Okay. Then again, the regulations are not applicable to the IIOs, means IFSC offices. Then whatever regulation these are made, this will be again revised or reviewed by the regulator every 3 years. Means in 2023 they have this regulation. So in 2026 they will it will be again be revised or reviewed. Then every Indian reinsurer including FRBs shall maintain a net retention of 50% in India. So 50% retention will be in India. Apart from that, we can do so. At least 50% should be in the country. Retention to an IIOs up to 20% of the Indian reinsurance business underwritten shall be counted as a part of the 50% retention. So when whatever retrocession we are doing into the IIO. What is IIO? IIO is a IFSC insurance offices, International Financial Service Authority insurance offices called IIO. So 20% you can transfer to IIOs also, but that 20% will be part of your 50% limit only. Then board approved all these we have to submit. The CEO of every insurer should submit to the authority a certificate within 90 days of the commencement of the financial year confirming the receipt of all original treaties. So that should also be again see in 45 days we are providing the reinsurance program. Okay, this one, and after in 90 days again CEO needs to be submit the that see whatever treaties you have mentioned, you have to take the signed copies also, and that we have received that have to submit it there. So other things when you will get this PPT, that time you will just go through, just you can read and go through. I'm not because due to shortage of time, I'm not repeating. I will just cover if you have any doubts, because we have very short time now. Already we have exceeded our time limit. This we have already covered. Just I will take doubts now. If you have any doubts, please ask me.
Sir, how can we get this PPT, sir? Please.
It will be shared on the group, WhatsApp group or Telegram groups.
Okay, thank you, sir. Thank you.
Okay, so we will get the PPT, but now if you are having any doubt, then we can discuss on that. Do you have any doubts?
So I have
Sir,
one
can you
doubt.
please?
Yeah, ask.
Sir, if we have to arrange the automatic session and the PML is 50%, when we will calculate facultative for the balance, we will give it for the 100 crore or 50% PML according to?
Please
like it
repeat
is
your
said
question.
that the balance have to be given to facultative. So balance, how we calculate balance for facultative according to PML or whole sum insured?
You tell me what was your question?
The question is like 100 crore is the sum insured and 50% is PML. 40 crore is automatic capacity like quota and surplus. Balance we have to give to facultative. Is it 10 crore or we are supposed to give the more? PML is the maximum for facultative.
Your question is not clear because you are telling that 40% is quota share and surplus.
Yeah, total 40% arrangement is already there.
Okay,
only 10% like 40 crore. So 50 crore is the PML. So how to calculate the facultative arrangement?
Right. Sometimes they are mentioning that balance is with the facultative. They are mentioning like this only.
This only.
But what is happening? You have to consider the retention also. Balanced. See now how the question is worded. Accordingly, you have to answer. You have to check it whether that is a net retention or a gross retention. Then how much is the retention? How much is the surplus? How much is the quota share? And you have to calculate this, and then balance will go to your this.
So if it is net retention, then we have to give 60
if you have
crore to
any
the
question,
facultative.
just please ask me that question. I will solve that question so that it will be.
Sir,
thank you.
Yeah. Sir, I want to put my submission in this.
Slide.
Yes.
Sir, I want
can
to
you go to the PML slide?
1 second.
Where we did calculate the MINDIP actually.
MINDIP, okay. Yeah.
Yeah. Here the PI. How did you calculate the PI?
PI. See, premium income will be given in your. We have not calculated PI.
Okay, okay. That was what I was confused.
Your premium throughout the year, na? At the end of the year, you will be coming to know what is your premium. That is your actual premium income.
Okay.
So see what you will get. You will get ENPI. You will get ENPI. You will get rate. You will get MDB percentage, and you will get PI. Got it? These four things will be there in your question. Okay. Now next question.
Sir, in the earlier part, there's one doubt asked by some other employee where they asked about this quota share and facultative placement. Sir, so in that case, quota share placement will be the deductible. Na? The new retention will be the whole quota share placement, right? When we go for the facultative, right, sir?
Capacity to that quota share, right? But now we have to see whether that surplus is also there or not. That's why I'm asking. If you have a question, you just ask that question. I will solve it here itself.
Okay,
That's the
sir.
worst.
Okay. Sir, what about CBR, sir? Do we need to learn about CBRs also, cross-border reinsurers? It will come in the exam?
Just go through the definitions only, and nothing else.
Okay, sir.
CBR and the definition only, just otherwise nothing is
And so this
important.
new idea circular, sir, new idea circular about this, what we can say, the retention that we have to keep 50% for CBR's placement and all. Is this the question will go
I
this
think
deep?
23 circular is that circular I mentioned here. Na? In 23 regulars, 23 regulations are good in that everything will be covered. You go through the 23 regulations, and
Okay, sir.
recently also there are some circulars, but the rules are same only. Uh,
Yes.
so see what you have to see these regulations here. See whatever changes are there, actually these are covered already here. So if you go through the PPT also, that will also suffice. And secondly, this is also one more thing, you should see that how much should be invested in which this one. But I mentioned 2018, you take the latest one.
Okay, sir.
Okay.
Okay.
Sir, there is a question. Many times I see some numericals where they have mentioned 4% obligatory, then 20% quota share, and loss is 100 crore. Sum insured is 150 crore. So how to solve that question? We have to first apply 4%
Now
of
see,
obligatory.
you are telling that 4% is a quota share, right?
No, 4% obligatory
Okay.
session, then
Okay.
20 or 30% quota share session.
Okay.
And
Then
other thing, and the sum insured is given, loss is given. So if 100 crore loss is there, the first we will apply 4%, that is obligatory, and make it 96%.
just from whatever information you have given, I'm framing one question and just giving the answer. Says 100 crore is a sum insured, okay, and 100 crore is a sum insured. For obligatory treaties, obligatory session is there, and 20% quota share is there, and loss is say 20 crore.
Yeah.
Okay.
Yeah.
If loss is 20 crore, first what will you do? 4% will go to the 4% will recover from whom?
GIC, it is obligatory means.
Yes, right. And in that only, whether it is a net means quota share will go, na. So quota share will take even including that 4% only, because we'll take a gross one, na. If net will be done, then 4% will be reduced and then we'll go. But we'll go for the gross one. Okay. So if in a gross one, again on that 20 crore only, 30% will be required from here, 4% from here. Balance we will with the insurance company. Sometimes there will be a combination of a surplus and quota share. That time you are telling of quota share only. No? See, I already explained that even your obligatory session is also kind of quota share only. So both are quota share. So by quota share only, you have to recover from both the reinsurer.
Okay. Sir, if it is surplus, then from 20 crores, first we will deduct 4%, and then it will be like something 16 crores. Then 16 crore we will apply that surplus.
Then it will be kind of whether you are taking a net line or gross line. Net lines means your retention becomes a line. Okay.
Yeah.
And gross line means your retention plus other arrangement becomes your line.
Okay. Okay.
Huh?
Okay.
Any other question?
No, sir. If it can be done in excess of loss, if same, then
in excess of loss it will not be happen, na. It will be in proportional only. In excess of loss there will be it will be a different arrangement.
Okay.
It will come in proportional only. Okay.
Okay. Okay. Thank you, sir. Thank you.
Okay. So I hope your due to shortage of time, something was remaining there, but whatever you asked, I think we have cleared all the doubts. If you still need anything, even you can ask later on. Okay. Maybe in the group, if I'll get time, I will just answer it. Okay. So all the best to all of you. We are ending
Thank you,
the
sir.
session.
Thank you, sir.
Thank you, sir.
Thank